Welcome back to another Macro Monday. And today we have a really fun one. We are going to talk about a massive AI bet that is hiding in plain sight. Now, I am not the first person that has talked about this dynamic, and I certainly won't be the last. And that's because emerging markets have performed really, really well to kick off 2026. You can see from the table here on the right, it is as of the end of April, April 30th. You can see that the MSCI Emerging Markets Index, which is what I will use to discuss emerging markets throughout this video, is up about 14.5%. And you can compare that to major US indices, such as the Nasdaq at 8.7%, the S&P 500 at 5.3%. And you can see that emerging markets have been a top performer amongst all of these marketplaces that I list here. Now, before we talk about the specifics of the AI component of emerging markets, I do want to mention this chart here on the left that shows the US versus EM outperformance cycles. I took this directly from the macro specialist designation, level 2A. And the main point to get from this is that US in emerging market cycles are typically measured in years. It's not something where you get this rapid back and forth movement. We have long-term macro backdrops that are supportive of international or emerging market equities, and then other backdrops that are more supportive of US equities. And that's what you see here. So these cycles go on for sometimes decades, right? So the most recent case, we've had this really long US outperformance cycle that stretched from about 2010-ish to it might still be going on. This is not me saying that the cycle has ended. You can see most recently from the chart, it has been emerging markets that have been outperforming US markets. This could just be a small blip in the continuation of the US cycle. However, what I do want to say is that investors, in particular the young professionals and the mid-level professionals, have yet to experience a macro backdrop that is supportive of emerging markets and international markets over US markets. And so, again, I'm not saying that this is what happens, but if you are looking at this chart, it does appear that we are potentially overdue for a flip in that dynamic. One other thing I want to mention before we get into the full AI story, US equities are usually more expansive than emerging market equities. That was true. I just grabbed a random date in 2017 in the middle of the US cycle. And you can see to today, that gap has widened into 2026. So I have the emerging markets forward PE versus the S&P 500 forward PE. And again, this isn't surprising that people are willing to, or investors are willing to pay more or a higher multiple for earnings in the US than emerging markets. It's generally considered more stable, more predictable. And so investors are going to pay more for earnings in a more stable and predictable market. And the gap is really, really wide. It's almost doubled, right? So right now, on a forward earnings basis, investors are willing to pay almost twice for US earnings than they're willing to pay for emerging markets earnings. And what's interesting about this is emerging markets, the composition of the MSCI index has dramatically changed over the last 2 decades. So the chart here on the right, the blue line is the sector weight of energy and materials, which traditionally, that's what you thought when you thought of emerging markets. There was a big commodity dependency. There was a lot of energy producers, materials companies. And what you can see what has happened, those types of companies have slowly become less and less important. And it's the technology side that's gaining a bigger weight in the index. Now, you may notice in the middle of this chart a dramatic drop in the sector weight. That was due to sector definitions changing. So a lot of the technology companies at that time got moved into some of the different buckets, discretionary, communication services, etc. But as you can see, even after that big drop, technology has just gone on to become an even bigger share of the index. And again, a lot of this is because of the AI play we're going to talk about in the next slide. I do quickly want to touch on the pie chart here on the left. So again, this is as of April 30th, the composition of the MSCI Emerging Market Index. It's not what you might expect, again, when you're thinking about traditional emerging markets. You can see technology makes up almost 37% of the index. And the next one is financial. So as these companies have become more financialized, for lack of a better term, financial companies in these spaces have become more and more valuable. It's up to 20% of the index. So over half of the emerging markets index is now made up of just technology and financials. So it's no wonder that the market is performing a little bit different than it did back in 2008, when almost 40% of the index was energy and materials. So I talked about AI at the start of this video. I haven't talked about AI yet. This is a little tease showing you that technology is now a greater part of the index. But now let's actually talk about it. So why are emerging markets such a big bet on AI? And personally, we hear a lot about the US markets being driven by the AI investment or hype cycle, whatever you want to, whatever word you want to use. Some might say bubble, but we haven't heard as much conversation about how that's driving emerging markets. And this is what I mean. So again, this pie chart here on the left is the MSCI Emerging Market Index as of the end of April, their geographic weight by country. And what's astounding to me is that 80% of the index is made up of 4 countries, all of which have strong relationships to the AI trade. So we'll go from top to bottom. In the blue, we'll talk about Taiwan. This one's a little bit self-explanatory. It's the home to TSMC. So Taiwan sits at the center of the AI hardware supply ecosystem. As AI grows, TSMC grows. TSMC is the largest individual name by a huge amount in the MSCI Emerging Market Index. Then you have China, which is probably equally self-explanatory. China is building a massive AI ecosystem across the board, applications, cloud infrastructure, as well as models themselves. There's been a few times where Chinese labs have released models, in particular, I'm thinking DeepSeek, that have really jarred US markets because they're able to produce them with worse technology due to a lot of restrictions that perform almost equally as well, and they're building them much more cheaply than the US companies are. So China is developing its whole own AI ecosystem. Then you have South Korea, which I didn't know this, but it commands nearly 80% of the high bandwidth memory market, which is very, very important for powering AI servers. And then you have India, which is a little bit more unique than the other 3, which are kind of just pure AI technology plays. On one hand, India obviously has a massive population, and they lead the world in workplace AI adoption. However, the other side of that is India has a huge services sector. In particular, they provide a lot of services to developed market companies, and that sector is greatly exposed to job displacement. So while the top 3 are more of a pure technology play, India holds a lot of users of AI. However, it is at risk of AI is at risk of constricting or contracting India's economic growth. So again, the main point I want to get across here, 80% of the MSCI Emerging Market Index is in countries that are greatly exposed or helping to build the international or global AI ecosystem. So when you look at emerging markets' really, really strong performance, I think a lot of that can be credited to the AI trade. Last thing I want to mention, I know I talked about the macro specialist designation a little bit earlier. One thing we teach, if you're interested in emerging markets, in level 2A, is how to analyze different emerging market countries. So it teaches you how to find emerging market opportunities. I went through the process myself. We teach you sort of how to build these tables. I built this table, and I got rid of the names of the countries that were ranked here on the left, but you can picture when I finish the exercise, I have a country at the top that is the most attractive. If I was looking to put money to work in a particular country. According to our framework here at the Macro Institute, that would have been the country. So if you're looking to pick up this type of knowledge, learn how to analyze different international or emerging markets, we do teach that in the macro specialist designation, in particular level 2. And that's what I'll leave you here today. Thank you for joining. I hope you enjoyed the video, and I will see you next week for another Macro Monday. Have a great week, everyone.